Hey, it's Darin Germyn here, and I wanted to talk to you about the differences between a variable rate mortgage and a fixed mortgage product. This is likely something you've been considering about how you are going to choose your mortgage, and there's some important information that you're going to want to know. When you are choosing your mortgage, you are making two bets, and a lot of people typically are going to gravitate towards a fixed mortgage first. The reason for this is simple. Nobody likes the idea of having to pay more potentially later on. They love the security of knowing what their mortgage payments are going to be every month. And quite often, people get into a fixed mortgage because they truly believe that the mortgage rates will go up. We get told that all the time by media, by the banks, by everybody. So fixed mortgages tend to be a pretty popular product. I mentioned that you're making two bets when you picked a fixed mortgage for the purchase of your home. Your first bet is that the interest expense is going to be better for you based on that fixed mortgage. Here's what I mean by that. Let's say there's a 1% difference between a fixed mortgage that you're considering versus the variable, where the variable is 1% less than the fixed mortgage you're considering. Historically, the Bank of Canada has raised rates by about 0.25% when they do rate hikes. And the reason you would pick a fixed mortgage is you believe that the bank may increase the variable, or in this case, the prime rate, to make it come up to match where that 5-year product might be. The reason this is a risky bet is simple. If historically the Bank of Canada is raising rates by 0.25 point, each time they do that, you're really saying that you believe the Bank of Canada is going to raise rates 4 times over the course of your mortgage, which very well could happen, but there's more. It's important to remember that you have saved money from the time you took that variable mortgage to the time those 4 rate increases happened, now equaling what the fixed mortgage rate at the time was. But there's more to the story than that. Just because that now equals the rate doesn't mean you've lost money. You've actually still saved money. So what happens if that rate goes higher than the fixed mortgage that you agreed to or could have agreed to at the time? That rate set by the Bank of Canada and prime rate needs to continue to go up. Let's say it goes up another 5, 6, 7, 8 times. And now the variable rate is 1% higher than the fixed rate that you could have taken years ago. In this case, you still are not necessarily losing money. You are starting to give some of the savings back over the course of time that you have collected being on a variable rate. So basically the first bet you are making is that the Bank of Canada is going to increase rates so many times that not only are they going to equal what that fixed rate that is available currently is, but they're actually going to exceed that. So not only are you going to create savings, but you're eventually going to give those all away and end up losing out based on picking a variable rate mortgage. I don't think that's typically going to happen, but that's bet number 1. Here's bet number 2. Bet number 2 is the penalty expense, and this is something many people borrowing for mortgage purposes do not get told. If you were going to get a 5-year fixed mortgage with a chartered bank, the big 6 banks in Canada, and even some of the credit unions, you are typically going to pay a mortgage penalty should you cancel your mortgage before that 5 years is up. And traditionally, that cancellation fee has been about 4.5% of the total mortgage amount. This is something called the interest rate differential and can equate to thousands of dollars of penalties when you cancel your mortgage. Now, here's the interesting thing. Kind of like a casino, the bank knows that 6 out of 10 Canadians will not see their mortgage term continued to the end. 6 out of 10 Canadians will break their mortgage before it comes to term. Now, I know what you're thinking. You might be that 4 out of 10 that isn't going to do that, but I've got news for you, folks. Life changes. There is job changes. There are family changes. There might be changes in your business. There are changes economically. People separate, unfortunately. There's all these reasons why sometimes we have to sell a house other than want. And a lot of times, even when it comes to want, 5 years is a long time to commit to a property because life changes a lot in 5 years. When you choose a variable rate mortgage, you typically will pay about 3 months of an interest penalty, or traditionally about 0.5% penalty on the total mortgage amount. That means there is a 9-time multiple difference between the penalty on a fixed mortgage and a variable mortgage. So when it comes time to pick what mortgage product is right for you, really consider those two bets and if you're willing to place them. Historically, variable rates have outperformed fixed rates for years and years and years in the long term. When you're getting your mortgage, be sure to ask the person helping you, how is the penalty calculated should you need to terminate or cancel your mortgage before the term is up? Knowing this alone and knowing not to just focus on the rate necessarily can help save you thousands over the course of time. And now you know the biggest differences between fixed rates and variable rates. Thanks for watching.